The S&P 500 is considered the gold standard by most investors. Today, we're going to be taking a look at some ETFs that have a higher performance than the indice, one of which I'm holding in my portfolio. I'm going to refer to these as the cousins of the S&P 500. So the S&P 500 is a foundation in many portfolios, but it's not the only way to get a part of those top companies. And to make today's video simple and fun, I'm going to be tying it to some of my favorite Rugrats characters. Bold leaders, very cautious, and smart overachievers. The S&P. It's built around the 500 largest companies in the US. But here's the catch. It's weighted by market cap. So basically, those giants like Apple, Nvidia, Google and Microsoft are driving the car, driving this indice, holding a little over 38% when it comes to those top companies in this indice. But there are many ETFs that give you a twist. So many investors have chosen to rely on some of those cousins of the S&P 500. Funds building off of that same start, the best 500, and then bringing in that tilt, a better fit for their portfolio and higher returns, leading to faster growth, higher momentum, a smarter weighting system. So today we're going to be comparing SPMO and MTUM, the momentum cousins, SPYG and SCHG, giving safer growth, and VUG and MGK, smarter growth options, tracks the S&P 500. I'm calling these two the Tommy Pickles of the bunch. SPM Invesco's S&P 500 Momentum ETF and MTUM iShares Momentum Factor ETF. So, for those of you who don't know, Tommy was a brave leader, bold, fearless, always moving forward. And that's exactly what momentum investing is. Buying what's already winning. PMO is an aggressive leader. It tracks the S&P 500 Momentum Index, rebalances twice a year. It has an expense ratio of 0.13%. It's concentrated and a fund that has definitely outperformed the S&P 500 indice. This is one that I've been investing into since late last year. I'm currently holding 194.2 shares and I'm up 24.17%, still on my journey to reaching my first 200 share goal. Then when it comes to MTUM, it's the smoother cousin, a bit of the same idea, but more diversified. It has an expense ratio of 0.15%, historically less explosive when it comes to the growth as compared to SPMO, allowing you to ride the wave just like SPMO. But you have to be ready for that because when the tide shifts, momentum investments can shift very quickly. So you have to be ready. An adventure, just like Tommy would be trying to drag you to get into. But when it comes to funds like this, they're definitely proving themselves and showing the reward. Year to date, MTUM is coming in ahead of SPMO, up 26% versus 24%. Over the last 5 years, SPMO is up about 182%, while MTUM is up 94%. And over the last 10 years, SPMO is up about 539%, while MTUM is up 372%. SPMO has 102 holdings, while MTUM has 130. SPMO has slightly outperformed MTUM on all time frames over a year. Both funds currently have the highest weighting into Micron. In SPMO, it's followed by Nvidia, Broadcom, Google, and AMD. And then in MTUM, it's followed by AMD, Broadcom, Intel, and Caterpillar. Now on to the two safer growth funds we're taking a look at are SPYG, the State Street S&P 500 Growth ETF, and SCHG, the Schwab US Large Cap Growth ETF. When it comes to Chuckie, he doesn't like chaos. He wants something that grows but doesn't feel reckless. Both of these funds have an expense ratio of 0.04%, giving an extra tilt to bring growth to your portfolio, but nothing extreme. S&P 500 based. SPYG has 147 holdings, while SCHG has 197 holdings. Both give you a smooth long-term performance, heavily weighted into mega cap companies like NVIDIA, Microsoft, Apple, Google, and Broadcom. So you're getting a bit of an edge, outperforming the S&P 500, but in a cautious, steady, predictable way. Those momentum funds are trying to be the gas pedal and get you full speed ahead, while funds like this, SPYG and SCHG, are the seatbelt, giving added growth, higher performance, but nothing scary. Now on to those cousins striving to be on the honor roll. These are the Susie Carmichaels of the bunch, VUG and MGK. VUG is the Vanguard Growth ETF and MGK is the Vanguard Mega Cap Growth ETF. When it comes to Susie, she was the smart one. Confident, balanced, always making the right choices. And that's why I chose to compare these ETFs to her. They are high achievers when it comes to being a cousin of the S&P 500. VUG has an expense ratio of 0.03%. It's one of the strongest long-term performing ETFs that you can find, concentrated in mega cap tech companies, clean, efficient, and powerful. Like Susie, it gets its homework done early. Then when it comes to MGK, it has an expense ratio of 0.05%. It focuses on the biggest, smartest companies that they're most confident about. MGK has just 64 holdings, while VUG has 158. So the top companies here are the same in both funds: NVIDIA, Apple, Microsoft, Google, Broadcom, and many others. But as we saw from the amount of holdings, MGK is more concentrated. Fewer companies have made the cut to be into this fund. And when it comes to performance, I'll just give you the 5-year on these two funds. MGK comes in at about 105% and VUG 96%. And when it comes to SPYG and SCHG, not sure if I gave a look at any of the performance, but on the 5-year, SPYG is up about 110%, while SCHG is up 106%. So we're going to take a look at a few points on all of these funds together. But if you want faster growth, and you can handle those swings, momentum, the Tommy cousins might be the right fit for you, an SPMO or MTUM. Smoother, safer growth options, the Chuckie cousins, as I'm calling them, SPYG and SCHG could be the right fit. And then high achieving growth funds would be the Susie Carmichaels of the bunch, VUG and MGK. But as always, this is not financial advice. Do your research. Find the fund that is the best fit for your timeline, your comfort, your risk. So taking a look at all of these funds together, along with VOO, which tracks the S&P 500, we can see that our momentum ETFs have the highest expense ratio, SPMO at 0.13% and MTUM at 0.15%, while all the others are at or below 0.05%. And as I said at the beginning of the video, I wanted to bring you some funds, some cousins of the S&P 500 that were outperforming, just following that basic indice. Here's a look at how these funds have performed over the last 3 years. SPMO is in the lead at 178% gain. Over the last 5 years, SPMO is up about 182%. Take a look at the performance for all of the other funds. But as you can see, all outperforming the S&P 500. And over the last 10 years, SPMO is up 539. So after having 9 straight weeks of the market going up, last week things started to cool down. I'm filming this on Monday, June 8th, and the stock market is still digesting the pullback that we just had. Inflation is high. Tech has been cooling off, but at the start of the week, the semiconductor names, which are leaders in many of the funds that we took a look at, are all in the green, up 3.49% on average today. But many of those other Mag 7 names are still in the red, like Apple, Google, Meta. As always, I'm still investing. I'm in the building phase, using red days to add to my SPMO. So let me know in the chat, which of the funds that I shared are you holding in your portfolio? Which would be the best fit when it comes to your investing journey? Are you like Tommy, Chuckie, or Susie? Which cousin would fit your portfolio? Feel free to drop a comment and let me know which fund or company you want to see a breakdown on next. I'll be coming to you with an update when I get to that 200 shares of SPMO. If you're not already, subscribe. If you didn't already, make sure to give this video a thumbs up, hype, and make sure to leave me lots of comments. Thanks for watching. Okay, bye.